Hello and welcome to this first session on Introduction to Finance and Financial Management. Now, many of us wonder what is finance, what is financial management. So financial management is a crucial business function, like other functions such as marketing management, human resource management, operations management. And finance is a common thread that runs through all of the business activities. Why do we learn finance? One of the important questions while we start this course. So, the very first answer is that of all the management decisions that are taken for an organization, the most crucial decisions are the ones where money is involved. And as the scale of business is growing, the money involved is also growing, and the decision's cruciality is getting increased day by day. Another issue is that money does not grow by itself. What we need to do is we need to invest the money to make it grow, to make it increasing, and this investment also should be done in assets that can generate value. What is value? Value is basically a function of costs and benefits of any asset. So, we have to define value and we have to derive value by the functioning of finance. The problem with this approach is, or not a problem actually, an issue with this approach is that people define cost and benefit in divergent manners. And so, the definition of value or the measure of value will be very, very different for them. Another important factor that we need to consider while we are learning finance is most of us feel finance is all about analytics. Yes, it is, but then it's not more about analytics, more about logic. It is as simple as choosing the asset which gets you a better return. There is no rocket science involved in it, it's simple logic. Moving ahead with financial management. So, how can we define financial management? So, as you can see, R.C. Osborne's definition clearly states that it is a process of acquiring and utilizing funds of a business. Bonneville and Dewey had put it like this: it consists of raising, providing, managing all the money, capital, or fund of any kind to be used in connection with the business. Another definition by Prather and Word also states that business finance deals primarily with raising, administering, and disbursing funds by different kind of business organizations. So we can make out that financial management is primarily about the two things, that is financing of a business, finding the source of capital, tapping those sources, and then investing the same. That is to see that the funds which have been acquired, which have been raised, are used in a proper manner, are being invested in the right avenues, and are giving us the value that we require. The various functions of finance are capital mix or financing decision. So as you can see, financing decision is our first decision, that is from where do we get the capital. So this decision will entail all the decisions that will have an impact on the capital mix of the organization. Similarly, when we have the capital, the next step we have to see that where we will invest this capital. So the very first place where we invest this capital is the long-term assets or the fixed asset. This kind of decision is called an investment decision or capital budgeting decision. On the other hand, we have a short-term asset mix or liquidity decision, wherein we invest the same money in short-term or current assets. This decision is called as working capital management. Another decision area which is more to do with corporate set of organizations is how do we divide the profits that have been generated from a business, technically called as the dividend decision. So in the financing decision, the major questions that form the decision are how much capital is needed, that is to decide upon the optimum amount of capitalization. Word of caution is you should not have more or less than the required amount of capital. So it is very necessary to check what is the exact requirement of capital that is there for you. Once you have decided the amount of capital, the next question comes into the picture: from where you are going to get these funds. There comes in the picture the various sources of capital. So we have debt, equity, and the various forms of debt and equity. Now, once we have decided the sources, the next question comes into the picture: what will be the cost of these different sources? So we have to learn a concept called cost of capital. We will be learning the various ways in which the cost is being measured. We also have to decide on mix of debt and equity, that is capital structure decision making, because the use of debt and capital can lead to a phenomena called as financial leverage. Many of the firms take advantage of this thing, but then this is a deliberate decision that we should be analyzing upon. The investment decision is relating to the commitment of funds in long-term or fixed asset that will yield benefit in future. So the time value of money analysis will be very important in this case. On the other hand, liquidity decision is about the investment of fund in short-term or current assets. Here the decision will be more of the nature of profitability liquidity trade-off, because these short-term assets or current assets are liquid but are not as profitable as fixed assets are. And as we said, dividend decisions are basically about deciding on the dividend payout ratio, whether dividend should be paid or not, and if yes, how much. So it is an exercise to find out the optimum dividend policy which can maximize the value of share. So why are we doing all of this? What is the objective of finance function? So earlier, because every other function of organization has a simple objective called as profit maximization, which was actually taken from Adam Smith's logic. According to Adam Smith, in a perfectly competitive market as per the price system, the main aim of the firm is to maximize profit, and that will lead to optimum allocation of resources. Why so? Because in this manner, the businessman produces only those products which are having good demand, can get better profits, and thus businessmen are pursuing their own self-interest and they are performing the interest of society also. Another advocates have told this that profit is a very appropriate measure of firm's performance. If a firm is performing well, the one metric that is surely going to reflect that is the profits that the firm is earning. So profit maximization can be taken as the objective of finance function. But then another school of thought has put objections against this. The nature of objections is, the first thing, what do we mean by profit? It's an ambiguous concept. Are we talking of net profit or gross profit, before tax, after tax, operating profit, non-operating profit? Which profit are we talking to maximize? So there is no precise connotation of profit in that sense. Another problem with this approach is that it ignores risk, because if we want to increase profit, we have to take more of risk also. But if we only talk of increase in profit, so that simply state that we are ignoring the risk concern. Another problem is that the time pattern of returns are ignored. So if a firm earns more in the beginning and less in the after period of his life, while there is another firm which earns less in the beginning but more in the after period, and the total profit of both the firms is same, so according to this approach, both the firms are same in their performance. Well, that is not a case. Another problem with this approach is profit maximization can lead to some practices or policies which are not in line with the social considerations. We may exploit our employees, we may exploit our customers, we may harm society. Those are the objections which are raised against profit maximization approach. So we have replaced it with another objective, that is shareholder wealth maximization or value maximization. According to this approach, the objective of finance is to maximize the net present value. What is the net present value? It is a difference between, or it is the excess of present value of benefits over the present value of cost. Now, according to this approach, any action which has a discounted or a present value stream of benefits exceeding the cost, it should be taken up. Now, this approach is better because, first of all, cash flows are much clearer term than profit. Secondly, it considers the time pattern of risk returns. And thirdly, it also considers risk by factoring the same into the discounting rate. Thank you very much.